Hello and welcome to BQ Prime. Recent RBI data shows that net FDI inflows to India fell to $28.7 billion in FY23. Now, this decline is led by a sharper fall in inward FDI. The fall in inflows appears to have been led by the services sector. To share his insights on some of these data points, we're joined by Aurodeep Nandi from Nomura. Aurodeep, thank you so much for taking time out today.
Thank you for having me.
So you've recently published some of your insights on the FDI data, and I do want to understand that, like even the report mentioned that, while a large part of the decline is because of global factors, domestic pull factors like supply chain relocations are yet to have a material impact on improving or lifting FDI inflows as well. So, I want to understand, does it look like a little bit of a disconnect between the India positive view vis-a-vis the actual numbers in terms of foreign investments?
So, Pallavi, I think it's first important to understand where we get a bulk of our FDI from, and versus the kind of news that one hears of, let's say, Make in India or PLI. Around 22% of our FDI is essentially IT, right? And then if you take the broader services basket, so this is stuff like hospitals, consultancies, telecom, construction, trading, you put all of that together, that's almost 65% or so of the total FDI. And so, much of what's happening in services will influence this particular number. It's only the remaining out of that a major proportion is industry. And so when the government talks of, let's say, PLI scheme or any of these other, better logistics, now all of this is aimed at possibly expanding the pie for manufacturing, right? But I think it's important to understand that in a short-term perspective, we are driven more by the services sector. Now, there's obviously going to be a demand. So there's the global side and then there's the domestic side. On the global side, if you have a year where there is a lot of uncertainty, where there is a lot of slowdown that's sort of inherent, that's sort of waiting on the wings, it is natural that investors are going to be more reticent in terms of putting FDI into emerging markets, including India. The pull factor there, it's not like there aren't pull factors, and by pull factors I mean there is a lot of talk in terms of relocating supply chains away from China, of the government trying to push across various sectors. But I guess the point that we're trying to make is that if you have a year where growth is in a tricky place globally, these pull factors are more structural factors which should kick in years. But currently, we are a predominantly services-driven FDI story. And what is probably reflective now is sort of the broader slowdown that one sees, for instance, in IT sector, in the other services basket, is maybe something that is filtering in. And of course, that is linked to the global side of the story. So that's what we tried to essentially say in this piece, that it's because the global side is doing very weak at this point that we're seeing FDI that's the fall vis-a-vis last year. However, on the manufacturing, there are pull factors, but they've still really not kicked in this year. And probably next year, we have a bearish outlook on growth. So it'd be difficult to envisage if this is indeed what's driving FDI, then next year is also going to be a rocky year. And maybe then after that, we'll start getting better FDI from the gains from reforms or expanding to other sectors.
Okay, so like you mentioned, again, going by the same rationale because of which FDI flows were lower in FY23, they are they're not expected to see any drastic improvement in FY24 as well. But early trends this year do seem a little bit better. What are you making of it at this point? And is the same reasoning expected to play out for the rest of this year as well? Or are there any changes, any other factors that will determine how things go on for the remaining of the current fiscal year?
I mean, in terms of factor, look, I mean, the data that we have now is up till March, right, of FDI. So, and in fact, the sectoral data is a little bit of a technical point, but it's not released by RBI, it's released by the government of India, and that's even more lagged. I think it's up till December or so. So, in terms of FDI, I don't think we have yet fresh data to comment on whether, what you started in FY24. I'm guessing what you're referring to is that there are strong coincident indicators that you're seeing across the month on growth side. And the question is, does this mean that that things are okay? I guess the thing that sort of worries us is the fact that developed markets have seen a sharp rise in their policy rates, and this has happened in a very small time frame. It's happened within a year, right? And yes, some of these economies are showing resilience, but eventually, right, you've hiked so much, and you're still looking to control inflation. I mean, if you look at the commentary one gets from Fed, they're still looking back at what is arguably a lagging variable, namely services inflation, and sort of seeing that, oh, well, have we hiked enough or should we hike more? And what is the link between hikes and inflation? That road runs through growth, right? So your whole idea is you slow down growth, and once you slow down growth, then inflation comes under control. So, and a lot of these effects are going to be non-linear. Like, for instance, no one could quite figure out how and when, the SVB crisis happened, but it happened. And then the system adjusted. So when you have a situation where you hiked so much, right, the impact of these hikes on growth, it can be linear, but it can also be non-linear, right? And in such a situation, your global growth situation is likely to remain weak. Now, for India, there are two things that kind of react quite a lot to the global side. One, of course, is the very obvious thing of exports, right? And I guess it's a little bit of a matter of worry that the fact that, even before a slowdown, so to speak, has happened globally, India's exports have already started underperforming quite a lot. So one is on the trade side. But on the other side, and this is probably less appreciated, is the India's capex cycle is actually pretty well linked with the global capex cycle. So whenever there's been a kind of precipitous fall in global growth, India's capex cycle has also suffered. Now, when you combine this with the fact that the RBI itself has done a series of domestic tightening, right? So it's not like India has not had a tightening of conditions out here. And you have consumption which has been K-shaped. You've got the certain parts of the consumption basket doing really well, others struggling. So you put all of that together, and then that spells out a lot of uncertainty for India's domestic prospects in FY24. So we have a below consensus forecast of 5.3% now for FY24. And so look, I'm not saying that FDI won't come. I mean, FDI will still come, and one expects that. But a lot of the FDI flow coming in is a global story, and the global story looks a little scary now. And as far as the India growth story is concerned, in the recent past, at least, it's very difficult to find a phase where India has been India's growth cycle has been fine and the global growth cycle has been falling. So, which is why the downside risk on India's growth are quite elevated this year.
All right. So, some of what you have said, especially considering your view of how you see the India growth story panning out in the current fiscal year, you do seem a little bit at odds with some of the RBI's commentary so far, which is definitely on a relative basis a little more optimistic, right? Uh, at this point, what are high frequency indicators looking like to you? And what is your reasoning? Like, what do you think is the reason behind the sort of disconnect between, say, maybe the RBI's view on India's growth in the ongoing fiscal versus yours?
So, I mean, I wouldn't like to comment on, how
Sure.
RBI has arrived at its focus. And but to answer your question on look, coincident indicators, what suggests this? The point is, coincident indicators by definition are coincident, right? So they are as we speak. In fact, they're with a lag because we get even the latest, the freshest data comes with a 1 month lag, right? But when you're making an outlook, you have to be forward looking, right? So you can wait for the data to start souring, and then you can say, oh, the drink has gone bad. But you also need to be a bit forward looking. Now, when you're doing a forward looking forecast, then you're in the realm of scenarios, right? So if one has a scenario, for instance, where global growth doesn't suffer as much, right? Then then India's growth is going to be relatively better off, because you will not have the kind of very sharp downside risks that one sees on growth globally. And to be fair, the lead lags with which monetary policy ends up impacting growth is something that is, that no model can tell you for sure, right? It's that's the nature of economics. So if one is, it really depends on what your inherent assumptions are, right? So
Okay, but all right, sorry, please continue.
Yeah, right. So if your inherent assumption is that that global growth is going to be hit, which is what our baseline case is, then there's likely to be an impact. And I mean, it's not just a global story. You look at how much in private capex, even despite anything happening, hasn't really picked up quite a lot. So it's primarily driven by the government, right? Whatever capex you see. Most of the capex. And then on the consumption side, it's also not that it's one strong story. Yes, it's broadly strong, but there are also certain parts of the story which. So, for instance, if you look at consumer durables IP, right, industrial production for consumer durables, it's been underperforming the index for months. In fact, by our estimate, it's below pre-pandemic levels, right? So, on one side, you might go to a mall, you might see a lot of people, you might get into an aircraft and see a lot of people, and then you might try to book a holiday and your prices are shooting up, and you might think, oh, okay, this means that everything is fine. But it's not that. That's all the indicators, even coincidentally, say the same story. You're seeing consumer durables do bad. You're seeing core imports, which is essentially a pulse of the economic growth. If growth is good, then you end up, a country like India ends up importing quite a lot. So if you take out oil, gold, the core import has been falling. So it's not like there aren't indicators that are showing some degree of weakness, but ultimately, your forecast 12 months down the line is going to depend a lot on what kind of world you envisage in your assumptions.
All right. So, but what I do want to know a little bit more about is, where is this drag expected to come in? So, like, for instance, we have seen merchandise exports slowing over the last few months. At the same time, private consumption figures in the last GDP release we saw were not encouraging at all. Private capex, you said, is yet to show a turnaround as such in any case. So where is more of this drag expected to set in from? Do you expect consumption trends to weaken further, especially considering some of the impact kicking in of maybe a tighter monetary policy, or is it something else?
So I think the biggest risk is obviously from the external sector side. Even even though services exports are doing well on a year-on-year basis, if you see the trend, it's starting to moderate. And the thing is that, I mean, our baseline case for our global economists, the baseline case currently is that the US sort of sinks into negative, US growth sinks into negative territory this year itself, right? And that's obviously a huge market, not just for merchandise, but also on the services side. So the first hit is going to be exports, right? So the lesser people getting into a Louis Vuitton shop in Paris, they're going to import lesser leather from, let's say, West Bengal, and that those linkages are there. The second aspect, as I said, is if you're on the investment side. So we are actually a bit worried on that side. So if your capex, yes, balance sheets are much better. But capex really hasn't picked up that much, and whatever has happened has been in certain sectors, right? And so the question that one has is that, all right, if you are actually in a situation where the global cycle turns, right? So you hike in the global for global central banks, and now you've reached a point where your inflation is slowly coming under control, but your growth cycle flips. Right, and once it flips, then the question that one has is, in that counterfactual, how eager are companies going to be to make expansion plans? Because typically, for doing that, it's not just clean balance sheets that you need. You also need certainty, right? You need a certain amount of. So I guess till that shadow passes off, a lot of people would be saying, all right, you know what, let's see where it goes. Now, on the consumption side, yes, you're absolutely right. There will be some lagged impact of the policy tightening, and that is by design, right? I mean, that's the whole, right? That's the way monetary policy works. And look, on the positive side, inflation has come off quite a lot, right? So it was 4.7% in April. Our estimate for May, which is going to come out next month, is it's tracking around 4.2%. So the inflation profile as of now looks like it could undershoot the RBI's forecast. So that should help consumption, because last year you had the story that, look, higher inflation was starting to bite into consumption, particularly on the rural side. So there should be some, tailwind that comes from there. But again, I mean, the second thing, of course, in this is what will happen on monsoons, right? So I know people like to look at monsoons and then look at inflation, but actually the link between monsoon and inflation is quite patchy. Between monsoon and agri growth is in fact a stronger correlation. So if you have bad monsoons, I mean, IMD today has been saying it's going to be normal, but if there is a problem on monsoon side, then you have a risk on the rural recovery that you're starting to build in at this point. And I guess what's also a little troubling is that even when you look at, say, any segment, let's say cars, you'll see that the demand is more for the higher end SUVs, EVs, and it's the mass segments that have sort of had a tougher time. And when so that remains a deficiency in the consumption story. I mean, whether that will get aggravated or not is anyone's guess, but I guess that's the vulnerability on that side. So what will get impacted? Probably exports, some bit of investments, consumption is on the risk, which now if you look at the GDP equation, consumption, investment, government spending, and net exports. So then you have a drag from net exports. You've got lower contribution from investments. And then your consumption side, you're not sure of that momentum, how much will hold. And so all of it then would be more dependent on the pace of government spending, right? So which is why we have a bearish outlook on FY24.
Got it. All right. So, before I let you go, one last question. Like we started off this conversation with regards to the FDI inflow trends. Since you've had a look at this data, over the longer term, do you sort of see any structural changes? So, for instance, like you said, it's a very small number of factors that predominantly drive FDI inflows. Do you see a diversification going forward in the middle term or in the slightly longer term? Like, what are the broader takeaways?
So I think the medium-term story looks promising because there is clearly a policy focus towards bringing in FDI, particularly in manufacturing. And obviously, some of these things you're trying to build an ecosystem. So it's not enough to just have a chip producing factory. Yeah, you need a whole ecosystem which kind of links up to your broader electronics plans, and then so it's a more complicated thing, which the investments will take some time to come. They will not happen overnight or within a year or so. Even then, I mean, if you look at just for instance, India's exports, you'll see the electronic side is doing quite well. The others have all slumped. So we are already seeing the first incipient signs of some fruit possibly of this policy. But look, I mean, at the end of the day, what is it that any investment, foreign, domestic, want? I mean, you would want land, you would need labor, you would need power. All of them, you need to get them reliably. You need ease of doing business, not just at central level, but also at state level, because that's where the actual, the actual points of contact are. And then you need good roads, ports, airports to take your goods out and bring your inputs in, right? It's so actually, if you think about it, it's a very simple kind of theoretical framework that you need for a boost for manufacturing. And I guess when one looks at the priorities, policy priorities currently, that seems to come across, right? So we've had a lot of roads being built. We've got a lot of focus on logistics. We've got a lot of focus on PLIs and manufacturing. We've got a lot of focus on digitization, which I think is very important from the services side of things. So it's not like you can ignore services. I mean, this is the most cutting edge part of the whole the growth story, right? So be it AI, be it other knowledge processing, other global centers of knowledge processing that kind of take place. All of it, for a lot of that, India needs to be geared up for that. So I think there's also that which is happening, and obviously India has a natural advantage in that and it kind of reflects in the FDI numbers that we see currently. So I mean, look, the medium term is always medium term. So it's crystal ball gazing at this point. But if one just looks at the initial conditions which are being laid out now, one would assume that once the global uncertainties reduce, India should be in a pole position to take on a lot of these, especially when supply chains across the world are trying to move. So this is a great time for India to kind of capture that evolving market.
Great. That's a fairly promising note to wrap up on. Thank you so much for taking time out to speak to us today.
Thanks a lot.